Okay, before we get started, let's start with the marine insurance first. So we need to know what is the marine insurance. Marine insurance is a key risk management technique that fits into the general risk management process adopted by ship financiers, a concept which is governed and construed in accordance to the law. Marine insurance is international in nature, since the subject matter of the marine insurance is the ship, or in our case, the vessel, which carries passengers and goods worldwide. Marine insurance covers the loss or damage of the ship's cargo, terminals, or any transport by which property is transferred, acquired, or held between the point of origin and the final destination. As a group, we have decided to choose marine sector. Hence, we decide to choose the sinking of the vessel tragedy as our topic for group assignment. In this assignment report, we will be based on the case of Venetico Marine SA versus International General Insurance Company Limited and 19 others, the case in 2013. This study aims to explore the role of marine insurance, providing insight about the marine insurance, which include risk claim, risk exposure, and suggestion, also the recommendation on how to manage and overcome the risk. So what is the issue or the incident of the case? The issue in this case are actually Venetico Marine SA, which is a company who own the vessel named Irene SM. Irene SM is the name of the vessel. Claimed 18 million from the defendant underwriters on the basis that on 30 October 2009, the vessel suffered damage caused by the insurance event in the Gulf of Combat. Their primary case is that the vessel grounded fortuitously and the damage was caused by the peril of the sea. Next, we will see the peril of the sea and what cause of it.
A very good morning to our lecturer and my friends. Before I start my presentation, let me introduce myself first. My name is Suvita, daughter of Rajaskaran, and my matrix number is 250707. Okay, today I will be presenting about Peril. Even though most of us are from risk management course, I still choose to explain the meaning of the peril. Peril is the cause of loss, the causes for the loss to be happen. Okay, in this case, the cause of loss is peril of the seas, rivers, or other navigable water. I think we have learned in our chapter 5, but still, let me give you the explanation for it, but it is same from the notes also. Peril of the sea refers to fire, enemies, pirates, thieves, barratry, jettison, and other added by special clauses incorporated in the policy, such as the Inchmary clause, which protect against damage to the machinery of the vessel caused by breakdowns or accidents in loading, discharging or handling cargo, bunkering, and entering dry dock. Next, I will be presenting about insurance cover. The ship was insured under hull and machinery policy, increased value policy, and anticipated cost of replacement policy. Under the H&M policy, the insurance covers loss of or damage to the subject matter insured caused by the negligence of masters, officers, crew, or pilots, provided that such loss or damage has not resulted from want of due diligence by the assured, owners, managers, or superintendents, or any of their onshore management. Well, what they are trying to say at here is the insurance covers the loss or damages caused by the negligence of master, officers, crew, or pilots, but it does not cover due diligence by the assured, owners, managers, or superintendents, or any of their onshore management. Now, I will be presenting about negligence of master crew. They did not observe that the vessel was dragging her anchor. This incident would not have occurred if the masters, officers, or crews had a close watch. The masters, officers, or crews didn't do anything to prevent the vessel drifting on the current before she grounded or was about to ground. The statement was given by the defendants. What they are trying to say is the master's officers of crews didn't watch the ship closely and they didn't do anything to prevent the ship when it was about to ground. Now, let me pass it to my next presenter.
So now I will continue and touch about the incident and claim. This incident happened during 30 October 2009, which leads on the voyage from Salalah in Oman to Dahesh in India. This incident happened when a crew moved a wishlist and anchor, resulting in the anchor being dragged and had be grounded. The circumstances of the grounding were never accepted by the underwriters. After a few months, during 9 December 2009, the owner served on the underwriters a notice of abandonment, and a couple of the day, 11th December 2009, a senior surveyor with Bureau Veritas who recommended that the vessel classification remain suspended. So, about the claim, the owner commenced proceeding against the underwriters for 18 million US dollar on the basis that the vessel was either an actual total loss or a constructive total loss. And the judgment state the three main point, which is must be followed by with the owners and the insurer company, which is both ship owners and underwriters must ensure that they maintain objectivity in both internal and external communication in order to show that they are diligently managing their claim. Secondly, as discussed above, experts should consider each case on its particular merits even if they have experienced a similar case before. And finally, claims for constructive total loss, especially ones that are not clear-cut, must be supported and defended with substantive documentation. The estimates must be as reflective as possible of the actual cost of repairing the vessel.
A very good morning to our doctors and fellow friends. My name is Mo Wei Xin, batch number 253201. Today I would like to present about the technique to overcome the risk exposure. The first technique is risk transfer. Risk transfer is a risk management and control strategy to shift the risk from one party to another. In this case, Venetico Marine SA, which is the owner of the vessel, it purchased insurance policy from International General Insurance Company Ltd and the others. And this action means that the company transferred their risk to the insurance company. So when accident happens, their loss will be reduced because insurance company will cover the loss. Next, risk avoidance. Risk avoidance is the elimination of perils, activities, and exposures that can negatively affect an organization's assets. For example, for those shipping company, they should avoid their ships to travel or pass through the dangerous sea areas. Besides that, the sailing should be postponed or cancelled when the weather condition is bad. And the third method I would like to present about is risk mitigation. Risk mitigation is a strategy to prepare for and lessen the effects faced by the data center. For example, the shipping company should implement the digital devices on their ships. The digital devices can help in navigation and also detection of the weather. It can detect whether the weather is good or bad. And those digital devices are able to prevent or reduce the accident to happen. That's all for me. Thank you.
For suggestion and recommendation based on the case, the peril faced by the vessel is the peril of the seas. Peril of the seas is the danger of the sea that cannot be controlled by human. To manage this type of risk, the technique that should be used is risk transfer technique. Based on the case, Venetico Marine SA purchased marine insurance from International General Insurance Limited. Venetico Marine SA transferred the loss of the risk to the International General Insurance Limited. To reduce the loss caused by the peril of the sea suffered by Venetico Marine SA.
Assalamualaikum warahmatullahi wabarakatuh. My name is Afdal bin Zulaiman Hassani. My mention number is 259272. Okay, let's go to the conclusion. As well as the legal risk involved with allegations made under the policy, the law itself can be a risk. Things can go wrong under the policy. In contrast, the subject of additional insurance is often confined to a small and separate territory. Due to the international existence, shippers and other relevant parties must be sufficiently wide-ranged in terms of risk in order to protect them from marine losses resulting from a variety of incidents in numerous jurisdictions subject to specific rules. Marine perils are described as perils that result from or are accessory to the sea navigations. The vessel accidentally grounded and the damage was caused by a sea peril regarding case of Venetico Marines versus International General Insurance and others. The perils of the sea are described by the action of God to cover all the ships.